Welcome to The Explainer. Today, we are tackling a highly requested topic, Topaz energy stock analysis. Is TPZ.TO a safe high-yield compounder or an overvalued energy royalty play? We're going to look right under the hood, run the cold hard valuation numbers, and see exactly what the data tells us. Let's get into it.
Here's our roadmap for today. We'll start with the core engine, then move into the X-ray. Check out the price tag, map things out in the investor's roadmap, weigh the shield and sword, and finally, wrap it all up with a bottom line.
Section 1. The core engine. First up, we need to understand exactly what Topaz Energy does and how they generate their cash.
So think of Topaz literally like a toll booth. They don't actually operate the costly, capital-intensive wells themselves. Instead, they run an asset-light royalty model. This means they just collect high-margin checks from incredibly reliable producers, like Tourmaline Oil, which happens to be one of Canada's absolute strongest natural gas producers. Because Topaz totally avoids the heavy capital expenditure burden of drilling, they're pulling in operating margins above 50%. Plus, they have incredibly strong cash conversion. It's scalable, it's durable, and honestly, it's highly efficient.
Section 2. The X-ray. Now it's time for a methodical deep dive into their financial and operational health.
Structurally, this business is fantastic. They have a solid, moderate moat driven by long-life royalty assets and that incredibly strong strategic tie to Tourmaline. Profitability is outstanding. Their trailing 12-month free cash flow hit a massive 178.1 million Canadian dollars. And the balance sheet is reasonably strong too. We're talking manageable debt of $571 million against $332.4 million in EBITDA. Management is also highly aligned with shareholders, boasting nearly 17% insider ownership, and the long-term outlook is quite bright, especially supported by potential LNG export expansions. But, well, here's the catch. They have an elevated PEG ratio, which, if you remember, measures price against both growth and dividend yield, sitting at 2.63. This basically tells us the stock is currently quite expensive relative to the actual growth and payouts you're getting.
So, what does this actually mean for your margin of safety? Right now, it's pretty minimal. You see, the market isn't missing the story here. Investors already deeply appreciate this royalty model and the stable cash flows it brings. Because everyone already knows it's a high-quality business, that quality is unfortunately already priced into the stock. Expecting a massive market-beating return from this exact entry point is going to be tough, unless their growth materially accelerates.
When we run all of this through a red flag scan, the primary risks become really clear. Declining free cash flow? Nope, that looks great. But it's those bottom two factors that grab your attention. Heavy reliance on a single customer, Tourmaline, creates a definitive concentration risk. Couple that with those steep valuation multiples we just talked about, and your upside is distinctly capped right now.
Weighing all 8 of our SWOT factors together, Topaz earns a really solid overall score of 7.0 out of 10. The strong royalty model and those massive free cash flow margins carry most of the weight here, scoring a 9 out of 10. However, that total score gets dragged down by the hefty price tag. It scores just a 4 out of 10 on valuation. And of course, their inherent exposure to natural gas cycles gets a 5 out of 10.
Moving on to Section 3, the price tag. Let's translate this qualitative data into a calculated intrinsic value. Okay, so our blended intrinsic value sits squarely at 29 Canadian dollars per share. The source gets there by averaging 2 specific metrics. First, a traditional discounted cash flow, which lands between $27 and $30. And second, a multiple enterprise value, which looks at what the whole business is worth including its debt, and that lands between $28 and $31. Now, with the stock currently trading around $31.77, it's floating slightly above its true intrinsic value.
To remain completely objective, we have to map out bear, base, and bull scenarios so you can see exactly how shifts in natural gas demand and valuation multiples drastically alter that baseline. If we happen to see a surge in LNG-driven gas demand along with strong acquisitions, the bull case pushes the value all the way up to $44. But if gas prices weaken and multiples compress, that bear case drags the intrinsic value way down to the low 20s.
Section 4. The investor's roadmap. Now we need to map out exactly when to buy based on your target returns. We can lay out your exact maximum buy prices by return target over a long-term 16-year timeline. If you're totally satisfied with a standard 5% annual return, while buying at $33 makes sense. But if you're a disciplined investor demanding a 9% annualized return, the math changes completely. Your maximum buy price drops drastically to 23 Canadian dollars. And if you are absolutely dead set on targeting that 9% return, Your holding period changes the game. Shorter horizons simply demand a much deeper discount. For instance, if you only plan to hold for 5 years, you actually need to buy this stock at $20 to hit that 9% target safely. Aggressive buying at current market prices just isn't supported by the math if you have ambitious goals.
Section 5. The Shield and Sword. Let's weigh the defensive stability against the offensive upside potential. We have a moderate risk score of 6.2 weighed against an opportunity score of 7.0. The opportunity is very real here. The unit economics are basically fantastic, scoring a 9 out of 10 in the source analysis. But the risk score is getting dragged up by market volatility and valuation. Simply put, it's a fundamentally excellent business, but current valuation premiums severely limit your upside asymmetry. You just aren't being compensated enough for the commodity risk right now.
Section 6. The bottom line. We've crunched the numbers, so let's get to the final verdict.
As our deep dive concludes, Topaz is undeniably a high-quality company in the Canadian energy space. It has incredibly resilient cash flow and a genuinely great dividend yield, but at current prices, it simply doesn't offer the margin of safety required for an aggressive new entry. If you're targeting those 9% returns, patience is absolutely your best strategy here. Wait for commodity volatility or broader market pessimism to drag the price down to that $21 to $24 range before deploying new capital.
So in a market completely starved for yield, is the fundamental safety of Topaz worth paying a premium for, or is patience the ultimate virtue for today's energy investors? I really hope this explainer brought some absolute clarity to your portfolio decisions. I want to know, which stock should I analyze next? Let me know down in the comments, and I'll see you in the next explainer.